Imagine this for a second. You're right there, command center stuff. Billions moving.
Yeah.
Screens flashing, markets churning, faster than you can even blink, really.
The pressure must be immense.
It's almost unimaginable, right? Every single click, every decision, it's huge stakes, massive gains or, well, devastating losses.
Mhm.
And you'd think, wouldn't you, that it's all just cold, hard algorithms, complex models, pure data.
That's the common perception, definitely. Like a fortress of math.
Exactly. But what if underneath all that tech, there's something else, something deeply human, an organizational puzzle?
That's what we're getting into today, isn't it?
Okay, yeah, let's really unpack this. We're doing a deep dive today into how these high-performance trading operations actually work.
Right.
Not just the theory, but through the eyes of someone who's actually managing a fund, a real-world perspective.
And this isn't going to be, a dry lecture.
No, definitely not. We're peeling back the layers, looking at the mix of data analysis, strategy.
And that crucial human judgment factor. How it all fits together for sustained success.
In this incredibly demanding world, how do they handle the pressure, the uncertainty?
And the source for this, it's really fascinating, is drawn from excerpts called Building a Resilient Trading Operation, System, Human, and Ego Management.
Okay.
What makes it special, I think, is it's truly behind the scenes. You don't often get this kind of view.
From someone actually in the hot seat.
Exactly. Someone responsible for both the market analysis, the hard numbers, and the performance of the traders,
Yeah.
the people,
Wow. Okay. So they see both sides.
day in, day out. It gives us a real window into a firm that doesn't just talk about risk, but actively manages it, all its different facets.
So our mission today,
Mhm.
what are we trying to do? We want to pull out the absolute key insights from this expert.
Mm-hmm.
Give you, our listeners, a shortcut. Understand not just what makes these operations resilient.
But how they do it,
Right.
how a top firm actually manages risk proactively.
Right. And these risks, they come from, what, 3 main areas?
That's what the source lays out. The systems, the technology,
Okay.
the people, the human capital,
Right.
and even the psychology, the trader's own mind, the ego.
And it's not just for finance geeks, right?
Oh, absolutely not. That's the really compelling part. Well, yeah, it's set in finance.
Mm-hmm.
The lessons here, they're about robust problem solving, resilience, managing people under pressure.
Stuff anyone can use.
Totally applicable to almost any complex, high-pressure job you might have. Leading a team, big projects, navigating uncertainty anywhere.
That universality, yeah, that's powerful. So let's start with the big picture, the philosophy behind it all.
Okay.
Because the fund manager has this core idea, and it's kind of counterintuitive, isn't it?
It really is, especially in finance where everyone's looking for that magic bullet.
Right. They're saying a successful operation isn't really about finding some mythical holy grail system,
Yeah.
the perfect algorithm that never fails.
No, forget that. It's much more about building the infrastructure.
Infrastructure.
Yeah.
Meaning what exactly?
Meaning a robust, adaptable system specifically designed to handle the times when things inevitably go wrong.
Ah, okay. So accepting failure is part of the plan.
Exactly. When the system messes up or when the human operator, the trader, runs into trouble, it's about managing those moments.
That feels mature, professional even.
It really does. The manager literally says it's about acknowledging that trading is hard IRL, hard in real life.
Ah, hard IRL. I like that. It's refreshingly honest.
It is. It cuts through the hype. It recognizes the market is chaotic, unpredictable things happen, people aren't perfect,
So it shifts the focus away from finding a magic wand.
towards building something that can withstand the storm. Practical, enduring strategies for dealing with reality.
It's not about avoiding problems because you can't.
Impossible. It's about building resilience, or maybe even anti-fragility.
Anti-fragility. Okay, explain that distinction. It's more than just being robust.
Yeah, exactly. Robustness is like you take a hit and bounce back to where you were. Anti-fragile means you actually get stronger from the hit.
Like an immune system. It learns from threats.
Perfect analogy.
Mm.
Or muscles getting stronger after stress.
Yeah.
This firm's philosophy is like building an organizational immune system.
So every glitch, every mistake.
Becomes data, an opportunity to learn, adapt, get better, stronger for the next time.
And you can see how that applies way beyond trading, right? Any field where things go wrong, which is, well, everywhere.
Absolutely. Tech, research, policy, business, stuff will go wrong.
The real differentiator isn't avoiding it. It's having the systems and the culture to diagnose, fix, and learn.
Mm-hmm. building teams that don't just absorb shocks, but actually improve because of them.
That kind of foresight is huge.
Precisely. It's about being prepared for the unexpected. And this preparedness, this anti-fragility idea, it leads right into their three-tiered support system.
Okay, let's break that down. Tier 1, what's that about?
Tier 1 is when the system itself starts to fail, when the trading strategy loses its edge. This is the analytical challenge.
Right, the model stops working as well. And the key point here is, it's not the trader's fault.
Crucially, no. The fund manager is very clear. This is an analytical problem first and foremost.
So a strategy that was great, maybe for months,
For years even.
starts underperforming,
Right.
losing money, not hitting targets.
Yep. And the manager says beliefs and emotions have a limited place here. Data governs.
Okay, very clinical. No blame game.
Exactly. Blaming the trader is pointless. He hides the real issue. The first question isn't who screwed up. It's what changed.
What changed in the market or in our model?
What do we need to understand and adapt to?
Because the market isn't static, is it?
Not at all. It's always evolving.
Yeah.
The manager gives examples like maybe market volatility suddenly spikes
Okay.
or disappears completely. That kills certain strategies.
Like a trend-following strategy in a choppy market.
Exactly. Or maybe the whole interest rate environment shifts. Central banks start hiking rates aggressively.
That changes everything.
Completely reprices assets, shifts capital flows, invalidates assumptions the model was built on.
Or even just correlations between assets changing.
Yet maybe things that used to move together now move apart, or vice versa. REX, pair trading strategies,
So the system, even if it was brilliant before...
is now out of sync, like running an engine on the wrong fuel.
So who steps in then? Who diagnoses this?
This is where the quantitative analysts, the quants, come in.
The math whizzes.
Pretty much. Their job is super specific. Rigorously stress test that underperforming model against the new market data.
Like forensic engineers for algorithms.
That's a good way to put it. They run intense backtests, not just passively, but simulating how it would have done in conditions like the current ones.
To pinpoint where it's breaking down.
Exactly. And they analyze model decay. That's a key concept.
Model decay sounds ominous.
It just means the model's effectiveness degrades over time. Not a bug, just market evolution.
So what worked in, say, 2015?
Might be totally useless in 2024's market conditions. Different inflation, different tech, different players even. The assumptions become obsolete.
And the quants dig into that.
Deeply. They also check the core assumptions. Are they still valid? The manager says they ask two key questions.
Okay, what are they?
First, are the signals still relevant? Are the things the model looks for still actually predictive?
Or have they just become noise?
Right. And second, has the noise increased? Has the random market chatter drowned out the real signal?
It sounds incredibly rigorous, all data, no gut feelings.
Absolutely. It's critical to keep the tools sharp.
Okay, so the quants are doing the microanalysis. Who looks at the bigger picture?
That's the market strategist. They step back while the quants are in the weeds.
Taking the 10,000-foot view.
Exactly. They ask, are we in a whole new market regime? A fundamental shift that this strategy just wasn't built for.
Ah, okay. Like that example that the manager gave.
Yeah, the trend following one. Works great in a clear trend.
But fails spectacularly when the market gets stagnant and volatile.
Right. So maybe a global crisis hits, market character changes completely. The strategist identifies that fundamental shift.
So you need both, the micro and the macro.
Absolutely essential. The quants show what's failing in the model, statistically. The strategist explains why it might be failing in the broader context.
Like having an MRI and knowing the patient's environment.
Perfect. It gives you the full picture for taking action.
Okay, so they've done the analysis. What action follows?
There's a clear hierarchy. First, maybe the system just needs adjusting. Minor tweaks.
Okay.
Or maybe recalibrating a more significant overhaul of its logic.
Right.
Worst case, if the markets change too much or it's too costly to fix, they retire it.
Just shelve it.
Yep, indefinitely or permanently. And the trader,
What happens to them?
they either get the updated model to trade, or if it's a big shift, they're reallocated to a different strategy that does fit the current market.
No blame, just efficient adaptation.
Exactly. And what's fascinating, really a lesson for anyone, is how quickly and unsentimentally they do this.
They don't get attached to the old tools.
No. They understand the tools need constant reevaluation, brutal honesty, willingness to discard what doesn't work anymore.
It's iterative improvement in action.
powerful stuff.
Yeah.
Acknowledging that yesterday's success doesn't guarantee anything today.
Very lean, very adaptable. Okay, that's tier 1. The system, what's tier 2?
Tier 2 shifts focus completely. It's when the trader has personal problems, the human factor.
Ah, okay. Moving from analysis to, well, people.
And this hits on that fundamental truth the manager keeps stressing. A trader is not a robot.
You're human, subject to life.
Exactly. Stress, grief, illness, family issues, all that stuff we all deal with, it directly impacts their cognitive ability, their discipline, their decision-making.
Especially in a high-pressure job like trading.
Absolutely. The cognitive load from personal stuff can just overwhelm their capacity for calm, complex thought, leads to mistakes.
And the firm sees intervention here as necessary.
Both necessary and smart. The manager says ignoring it is unethical, obviously, but it's also just bad business.
Right. A compromised trader is a risk.
A huge risk. They can lose a lot of money, not just for the firm, but cause themselves immense distress, too.
So it really forces you to think about employee well-being holistically, doesn't it?
It does. Recognizing the whole person, not just a performance number. Personal struggles don't vanish at the office door.
And the pressure cooker environment can even amplify them.
Precisely. So what do? They bring in HR and occupational health.
Formal support systems.
The firm sees it as their responsibility. Offer confidential support, non-judgmentally.
Like what? Therapy?
Could be. Confidential chats with a therapist, maybe help with stress management techniques.
Mindfulness, breathing exercises.
Stuff like that, yeah. Tailored for high-pressure roles. Or sometimes recommending they actually take a break from trading.
Step away for a bit.
Yeah, give them space to recover without the market pressure. It shows they value the person long-term, not just short-term profits.
That's a very different model than just, perform or you're out.
Worlds apart. It's about retention and well-being.
And it's not just formal HR stuff, right? There's something about mentors.
Yes, huge emphasis on mentors, usually a senior, experienced colleague.
Why is that so valuable?
Because, as the source says, sometimes the best thing is talking to someone who's genuinely been in the same situation.
Ah, someone who gets it. The specific pressures.
Exactly. Someone who's maybe navigated similar personal storms while trading. The empathy and shared experience are invaluable.
And it's different from HR how?
It's completely outside performance reviews or disciplinary tracks. It's peer wisdom, a confidential sounding board, non-judgmental.
That validation must be incredibly helpful.
Hugely, especially if someone feels isolated. It's that human touch.
So, with this support in place, what's the actual action taken regarding their trading to protect everyone?
Often they'll temporarily reduce the trader's risk. Smaller position sizes, fewer trades, less volatile stuff.
Limit the potential damage while they're vulnerable.
Right, and sometimes they use simulated trading, paper trading.
Ah, practice trading without real money.
Exactly. Lets the trader stay engaged, keep analyzing, practice execution, but with zero financial risk.
So they can rebuild confidence and discipline.
Until they're mentally and emotionally ready for live trading again. The focus is clearly on the person's well-being and getting them back to their best.
It's an investment in their human capital.
Absolutely. And a lesson for everyone, regardless of industry, even in number-obsessed fields, the human element is critical.
A supportive culture pays off long-term.
Leads to better outcomes, better retention, more resilience overall. Peak performance needs psychological safety.
Really vital takeaway. Okay. Empathy and strategy working together. Now, tier 3. This sounds tricky.
It is. The manager calls it perhaps the most difficult and common cause of performance issues.
Which is?
When the trader has ego issues, a psychological fault.
Whoa. Okay, so this isn't external problems. This is internal.
Entirely internal.
Right.
Insidious. Psychological. Where the market's feedback clashes with human psychology.
How does that manifest?
2 main ways, according to the source. First is overconfidence. Hubris.
After a winning streak.
Exactly. Trader has a great run, feels invincible, starts thinking they're special, the rules don't apply to them.
So they take bigger risks. Ignore their plan.
Yep. Follow gut feelings, ignore stop losses, because they feel right. Recipe for disaster.
And the other side of the coin.
Fear or revenge trading.
Yeah.
Usually after a big loss,
Okay.
fear can make them freeze up, miss good opportunities, or worse, trigger this irrational need to get revenge on the market.
Revenge trading. Sounds bad.
It is, making impulsive, huge bets to try and win back losses instantly. Make it back in one trade.
Which almost never works.
Almost never. Just digs a hole deeper. So whether it's hubris or fear of revenge,
The result is the same.
they deviate from their proven strategy, their discipline breaks down, and they lose more money, often unnecessarily.
Man, it really shows the psychological gauntlet traders run. Confidence can become arrogance. Dealing with loss is brutal.
It's a huge test, magnified by the instant feedback and financial stakes.
So when these ego issues pop up, who deals with that?
This requires a real specialist,
Mm-hmm.
a performance coach or a trading psychologist.
Like a sports psychologist for traders.
Exactly like that. Not a general life coach. Someone who understands the specific mental game of high-performance trading.
And what do? Identify biases.
Precisely. They're experts at spotting and helping correct cognitive biases that plague traders. The manager mentions key ones.
Like?
FOMO, fear of missing out. Jumping into a trade because everyone else is, not because your analysis says so. Driven by anxiety.
Right, emotional decision.
Then revenge trading, trying to fight the market after a loss. And the inability to accept a loss. Just holding on to a losing trade, hoping it turns around instead of cutting it like the plan says.
Stubbornness. Ego.
Exactly. The coach helps the trader see these patterns and build strategies to manage them.
It really is like elite athletes, isn't it? Physical talent isn't enough if the mental game isn't there.
Absolutely. Choking under pressure, getting cocky, dwelling on mistakes, it kills performance. The coach provides mental conditioning.
Techniques for emotional regulation, focus, mindset.
Treating success and failure as data, not personal judgments.
And how do they actually do this? What's the process?
It's often quite structured. A key tool the manager highlights is detailed journaling.
Just logging trades.
More than that. Logging trades, yes, but also their emotions and thoughts at each decision point.
Wow. Getting inside their head during the trade?
Exactly. What were you feeling? What thoughts were running through your mind when you deviated from the plan? It creates self-awareness.
And the coach analyzes these journals.
Meticulously, often with the trader. Helps them spot destructive patterns they might not see themselves.
They're like, I always get reckless after a big win, or I panic sell too easily.
Right. Then they work together on concrete techniques.
Yeah.
Pre-trade routines to get in the right mindset. Mindfulness during volatility. Objective post-trade debriefs.
Building healthier mental habits.
Exactly. The ultimate goal. Reconnect the trader with their original, proven process, the one that worked before the ego interfered.
And this is where it gets really interesting, right? Because this isn't just trading.
Not at all. It's a blueprint for managing bias and emotion in any high-stakes field.
Athletes, surgeons, lawyers, leaders making big calls.
Anyone where judgment under pressure is key. The ego can be a silent saboteur anywhere.
And this approach, structured coaching, self-awareness, offers a path to control.
Turning a potential liability into strength. It shows that raw talent or intellect isn't enough.
Emotional and psychological fortitude are just as vital, maybe more so.
For long-term, sustainable success, absolutely.
Okay, so let's recap. We've gone through the tiers. The core message from this fund manager seems incredibly strong.
It really does.
A successful, resilient trading operation isn't about finding that magic holy grail system.
Nope. Forget the myth.
It's much, much more about deliberately building a robust, adaptable infrastructure.
One that's designed to anticipate and manage.
Those inevitable times when the system, the tech, glitches.
For the human operator, the trader, faces personal challenges or psychological battles.
It's about preparing for trouble.
And that leads back to that quote, doesn't it?
The hard IRL one.
Yeah. Acknowledging that trading is hard IRL is the definitive sign of maturity and professionalism.
It really sums it up. It's about humility, foresight.
The honesty to admit when things aren't working, and the willingness to invest in real solutions.
Whether that's data scientists, HR support, or psychologists.
It's all part of an integrated system, moving beyond a simplistic view of success.
Embracing the messy reality. So these 3 tiers, tackling system failures with data, handling human issues with empathy, confronting ego faults with coaching.
They create this comprehensive, resilient approach.
It's not about perfection. It's about building an organization that learns from every tremor, gets stronger.
A truly holistic view. Technical, personal, psychological, all interdependent.
Okay, so final thoughts for our listeners. As you go about your day, maybe think about this in your own world.
Yeah.
In your field, your projects, your team.
Yeah.
What are the systems that might be losing their edge?
Could be old processes, outdated tools, assumptions that aren't true anymore.
Right. And then what about the human factors, your own or your team's?
Stress, burnout, personal stuff impacting focus and decision-making.
Things we often overlook. And maybe the toughest one. What ego issues might be subtly derailing things?
Oof, yeah. Overconfidence after success. Taking things too personally after a setback. Refusing to admit a mistake.
We all have them, right?
Absolutely.
So the big question, building on this manager's insights, what kind of robust, anti-fragile infrastructure are you building?
For yourself, your team, your work.
To anticipate these things, diagnose them, address them compassionately.
And actually learn from them, getting stronger each time.
It's a really powerful thought to leave with. Maybe the greatest edge isn't just performing when things are good.
But how intelligently, how methodically, how compassionately you prepare for when things inevitably go wrong.
That feels like the real secret sauce. Something to really mull over.